Bull Bear Buzz podcast for decoding markets, fueling minds.
Welcome to this deep dive. Today we're taking a close look at ICICI Bank's performance, specifically their fourth quarter for the fiscal year 2025, which wrapped up at the end of March.
Right.
You shared their investor presentation and the financial results reports with us. And the idea really is to get a clear picture of their financial health, where they're growing and the quality of their assets.
Yeah, absolutely. There's a lot in these documents.
Our mission then is to kind of unpack all those numbers and narratives, cut through the jargon, and just give you the key insights. Sound good?
Sounds perfect. Let's get started. Where should we begin? The overall profit picture.
Yeah, let's start there. The big headline number.
Okay, so looking at their standalone profit after tax, it grew by a pretty solid 18.0% compared to the same quarter last year. That brought it to euro 126.30 billion for Q4.
Wow, 18%. That's quite a jump year on year. What's driving that?
Well, it seems like their core operations are performing well. If you look at profit before tax, and you take out the treasury part or, how they manage their own investments, that figure grew too. It was up 13.2% year on year.
Okay.
And maybe more importantly for recent trends, it was up 8.1% just from the previous quarter, Q3. Reaching 165.34 billion.
Right, so sequential growth too. That suggests good momentum heading out of the fiscal year.
Exactly. And one more core number, the core operating profit. This strips out even more, like provisions and tax, to really show the engine room's performance. That saw a growth of 13.7% year on year and 5.5% quarter on quarter. So it hit 174.25 billion.
Okay, so strong profit growth pretty much however you slice it. Let's dig into where that money's coming from. Revenue streams, net interest income first. That's usually the big one for banks.
It is. And their net interest income, or NII, it increased by 11.0% year on year.
11%. Decent. Shows they're earning more on loans than they're paying out on deposits, basically.
Precisely.
Yeah.
But what was perhaps even more striking this quarter was the non-interest income.
Oh, yeah. How did that look?
It grew significantly, 18.4% year on year. And a huge chunk of that was driven by dividend income from their subsidiaries. That specific part, the dividend income, was up a massive 39.5%.
39.5%. So the companies ICICI owns are doing really well and paying back nicely to the parent bank.
That's exactly it. It shows the strength isn't just in the core banking alone. The subsidiaries are adding real value, gives them a more sort of diversified earnings base.
That makes sense. And what about the more typical non-interest income, like fees?
Fee income also showed healthy growth. It was up 16.0% year on year. So things like transaction fees, loan processing fees, card fees, all contributing positively.
Good. So multiple engines firing on the revenue side. Okay, let's flip to the other side of the balance sheet funding. How are deposits looking?
Deposits look strong. Their period end total deposits grew by 14.0% compared to last year.
14%. That's robust growth.
And they also saw a good jump just from the previous quarter, up 5.9%. Shows they're attracting funds consistently.
What about the type of deposits? Anything interesting in the mix? Like ICICI current and savings accounts?
Yes, that's a really important point.
Yeah.
Period end current account deposits were up a very strong 20.3% year on year.
Wow.
And savings account deposits grew 9.6% year on year as well.
So that low-cost CASA base is getting stronger. That's generally good for margins, right?
Absolutely. It's cheaper funding for the bank. Looking at the average deposit levels over the quarter, they were also up by 11.4% year on year. So consistent growth there too.
Okay, strong and improving deposit base. Now let's talk about what they do with that money lending. How's the loan portfolio shaping up?
Overall, domestic loans grew 13.9% year on year and 2.2% quarter on quarter. So continued expansion.
And within that, any particular areas standing out?
Oh, definitely. Business banking was on fire, relatively speaking. That portfolio grew by a huge 33.7% year on year. And even quarter on quarter, it was up 6.2%.
33%. Okay, so they're really pushing into lending for businesses.
Seems like a key focus area, and they're getting traction.
What about the retail side? Mortgages, personal loans, etc.
Retail loans grew too, but at a more moderate pace. It was 8.9% year on year and 2.0% quarter on quarter.
Still growing, though. And I remember reading mortgages are a big chunk of that.
Yes, very significant. Mortgages make up about 61% of their total retail loan book. So that steady growth in home loans provides a really stable base.
Okay. And corporate loans. How did the big company lending look?
Domestic corporate portfolio grew 11.9% compared to last year. So decent annual growth. But interestingly, it actually saw a very slight dip compared to the previous quarter, down 0.4%.
A slight dip quarter on quarter. Could be just timing of repayments or maybe a bit more caution.
Could be either, or a mix.
Yeah.
Not a major decline, but worth noting the difference compared to, say, business banking's trajectory.
Right. Okay. So loan growth overall is positive, led strongly by business banking, steady retail, and slight QQ pause in corporate. Now, the crucial bit, asset quality. How are those loans performing? Are NPAs under control?
This is definitely a highlight for them this quarter. The net NPA ratio, that's non-performing assets after provisions, improved. It came down to 0.39% at the end of March.
0.39. Wasn't it higher last quarter?
It was 0.42% in December. So a noticeable improvement. A lower ratio here is definitely a positive signal. Better loan performance, essentially.
That's really good news. And the actual amount of bad loans, the gross figure.
That also decreased significantly. Gross NPAs fell to euros 241.66 billion. That's down quite a bit from 277.45 billion the previous quarter, and also down from 279.62 billion a year ago.
So fewer problem loans overall. And are new problems slowing down too, like the fresh slippages?
Yes, that's another positive point. The net additions to gross NPAs, basically, new bad loans minus recoveries and upgrades, dropped significantly. It was only 13.25 billion in Q4 compared to almost 27 billion in Q3.
Wow, that's a big drop. Suggests better underwriting or recovery efforts are kicking in.
It certainly points towards healthier trends in the loan book.
And how much are they setting aside to cover potential losses? The provision coverage.
The provision coverage ratio, or PCR, stood at 76.2%.
76%. That sounds like a reasonably strong buffer.
Yeah, it's generally considered a healthy level. It means they have funds covering over 3/4 of their gross NPAs already set aside.
Okay, so the asset quality picture looks quite reassuring. Improving ratios, lower absolute NPAs, fewer new problems. Let's talk about a bank's own financial muscle, its capital adequacy.
Right. They continue to be very well capitalized. Their Common Equity Tier 1 ratio, or CET1, which is a key measure of core strength, was strong at 15.94%. And that's after factoring in the dividend they plan to pay out.
15.94%. That's well above the regulatory minimums, gives them a solid cushion.
Definitely. And their total capital adequacy ratio on a standalone basis was 16.55%.
Again,
very comfortable.
Provides a good foundation for growth and, absorbing any unexpected shocks.
Exactly.
And you mentioned the dividend.
Yes. The board has recommended a dividend of 11 per share for the fiscal year. Of course, that's subject to shareholder approval and other formalities.
11 rupees per share. Okay. Now, earlier you mentioned the subsidiary has really boosted non-interest income. Can we touch on their performance a bit more?
Sure. The key ones, like ICICI Prudential Life Insurance, ICICI Lombard General Insurance, and ICICI Prudential Asset Management, all reported strong profit after tax growth. One notable point is that ICICI Lombard's status changed during the period. It moved from being an associate company to a full subsidiary.
So ICICI Bank has more control now.
Precisely. Greater controlling interest.
And wasn't there another change with ICICI Securities?
Yes, that's right. ICICI Securities, which used to be listed separately, has now been delisted. It's become a wholly owned subsidiary of ICICI Bank.
So fully integrated back into the bank structure. Interesting. That could change how things operate there.
Potentially, yes. Closer alignment, maybe some strategic shifts down the line.
Okay. Let's circle back quickly to lending. You mentioned mortgages dominate retail. Any other interesting bits about their retail strategy? They talked about digital, didn't they?
They did. They're pushing digital initiatives hard. Mentioned things like iLens for digital lending, instant car loan dispersals, even a dream car search platform.
So using tech to streamline things for customers.
Seems to be the focus. Also interesting, they highlighted that a lot of their retail, rural, and even credit card business comes from existing customers.
Loyalty pays off, I guess.
Yeah.
Lower acquisition costs, too.
Probably. And they also noted a high percentage of personal loans go to salaried individuals, which is often seen as a lower risk segment.
Right. And what about that fast-growing business banking segment? What's their approach there?
They emphasize a few things. Parameterized lending, so using clear rules and data. Granularity, meaning spreading the risk across many smaller loans rather than a few huge ones. Focusing on collateral and active monitoring.
Sounds like a structured, risk-aware approach.
That's the impression. They're using their branch network, but also digital platforms like their InstaBees app to drive this growth.
Okay. Now, thinking about risk, Banks always have exposure to different sectors. Did they give any details on exposure to potentially sensitive areas, like power, or NBFCs, or real estate builders?
They did provide some breakdowns. They showed exposure figures for the power sector, NBFCs and housing finance companies, and the builder portfolio. Importantly, they stressed that the level of NPAs within these specific segments remains low.
That's reassuring. And what about concentration risk? Are they heavily reliant on a few big borrowers?
They addressed that too. They mentioned that all of their top 20 borrowers, based on exposure, have an internal credit rating of A or better.
A and above for the top 20. That suggests lower risk concentration at the very top.
Exactly. And that focus on higher credit quality seems consistent. They also show that the majority of their overall domestic corporate portfolio is rated A and above.
So a clear preference for lending to stronger rated companies.
Seems to be a core part of their strategy.
One last technical point, maybe. Any major accounting changes we need to be aware of that might affect comparisons?
Yes, that's actually quite important. During this fiscal year, the RBI, the Reserve Bank of India, brought in a new master direction on how banks should handle their investment portfolios. Because of these changes in classification and valuation rules for investments, some figures, especially around investment income or valuation gains losses, might not be perfectly comparable to previous periods.
Right. So just keep that footnote in mind when looking at trend lines involving investments.
Exactly. It's a standard change affecting banks, but good to remember.
Okay. So wrapping this up, as we've sort of unpacked these results, the picture that emerges for ICICI Bank in Q4 2025 is one of, well, pretty solid performance, wouldn't you say?
I'd agree. You've got strong profit growth across different metrics. You've got that significant improvement in asset quality with NPAs coming down.
Yeah, the asset quality part really stands out.
And they maintain very strong capital reserves.
Yeah.
Plus, the focus on digital seems ongoing, and those subsidiaries are clearly contributing significantly now.
A pretty positive report card overall for the quarter and the fiscal year end.
It seems that way based on these numbers. Now, just a reminder for everyone listening, the information we've discussed here is purely for educational purposes. It's not financial advice. We aren't SEBI-registered advisors.
That's crucial. Investing in stocks always involves risks. You could lose money. So please consult with a SEBI-registered advisor before making any investment decisions.
Absolutely. We're not liable for any losses that might come from decisions based on this discussion.
And for more unbiased market updates and analysis like this, do make sure to subscribe to the Bull Bear Buzz podcast.
Definitely.
So this deep dive gives you a detailed look at ICICI's Q4, but as always, we encourage you to check out the full reports yourselves if you want even more granularity. What really stood out to you the most from all this? And perhaps what further questions does this raise as you continue learning about the banking sector? Something to think about.